Good morning, guys. Welcome to preparation for the Bank of England's quarterly inflation report for February. Very briefly, what we're going to have a look at. We're going to look at the Bank of England's interest rate stance and their outlook. We're then going to move to the format of the meeting and how it's going to be released in terms of timings. We're then going to have a look at the previous Bank of England QR meeting, try and pick up what the Bank of England stance was then, so we can get an idea of what the stance could likely be tomorrow. We're then going to move on to the inflation data. So all the data that affects inflation over the last month or last couple of months, and we're going to have a look at some charts. We're then going to move to the market pricing and expectations. From there, we're going to have a look at any outlier trade opportunities, okay, because that's obviously where the traders can make money. And then just briefly at some market structure. Okay, so let's move to the Bank of England. As you can see, the vote structure is now back to 9-0. Okay, we did previously have Martin Wheel and McCafferty both voting for an interest rate hike. Okay, that was already from last year. However, because inflation kept going lower and lower, both of them decided that they no longer were calling for an interest rate today. Okay, and the vote went back to a 9-0 in favour of no rate hikes. Okay, and again, obviously, that was due largely to the oil, as you're going to see as we go down. Okay, then very briefly, in order to get just a good feeling for the Bank of England, it's always good to understand the governor. Okay, so we're going to take a look at what Mark Carney's been saying to us over the last couple of months, so we can get a little feel for what his idea is about interest rates going forward. Okay, very briefly, he said that inflation is likely to turn negative for a period, okay, largely due to the oil price, and that it should pick up in 12 months. Okay, so if tomorrow comes out and we get a reiteration of this, or in the months ahead we get negative inflation, okay, that's not new news. The market should already know that. It should be reflected in the current price. Okay. He also said we should look through the impact of oil on inflation so long as wages are growing. Okay, so there comes another hint. If suddenly wages start to turn whilst inflation's coming down, whilst oil is lower, then we're going to suddenly start to have a Bank of England that's a little bit more worried about inflation. Okay. He also said that he expects wage growth to continue the trend. I'm going to show you a little bit later. I'm going to show you what the wage growth chart looks like, and you see we're developing a very strong trend at the moment. Okay, we've had 6 months in a row of continuous wage growth. Okay. Bank of England then said, or he then came out and explicitly said that the Bank of England has the will, the ability, and the duty to return inflation back to 2% in the next 2 years. We're going to have a brief look at what he meant by that, because there is a potential trade opportunity on that exact comment that he made. In other words, what does he mean particularly by that will, ability and duty? He then also said that the rate path is more gradual and limited than a year ago. So instead of hiking, say, 4 times a year as it was a year ago, we're looking more likely at maybe 2 hikes a year going forward. And then that the ECB QE program was significant. Okay. Mark Carney has attributed quite a bit of the slowdown in inflation to the slowdown in Europe. So the fact that now the Eurozone has finally embarked on QE, all right, maybe that's going to allow UK to start growing where it was growing before we obviously saw the interest rate hikes pushed out a bit. Okay, so currently in terms of pricing, the market is very dovish, guys. All the banks are currently looking at a rate hike late 2015, early 2016, okay, whereas the market's pricing currently, you're looking at somewhere around the middle of 2016, back end of 2016. Okay, so the market's very, very dovish, and there's reasons for that. Obviously, we've seen over the last couple of months, all bond markets are rallying on this idea of search for yield. Okay, so it has been pushed further out on the idea of, you know, later hikes and slower growth. Okay. Just in terms of what the oil's done, and I will show you a chart of that, since July last year, we've dropped from $108 to $44, just to give you a little bit of an idea of how big the oil move's been. Okay, I know it's not just the Bank of England that's moaning about this, or that's saying that that's the reason for inflation dropping. Okay, the Fed's also doing the same thing. But if you just think about it, we've dropped more than 50% in the last, 6-7 months. Okay, so remember that feeds into inflation, because inflation oil has a big impact on the inflation in the economy. Okay. Then just very briefly, something Kristen Forbes said. I think this stands out and it's worth mentioning. Kristen Forbes is new on the board, and she actually came out recently in the last couple of weeks, and she said that the Bank of England may need to hike sooner than people are thinking. Okay, and it's important that we note this because we've already got two dissenters in McCafferty and Wheel. All right, so we do know fine well that Kristen Forbes is likely to be the third dissenter on the Bank of England. Okay, but equally, she is going on all about how that the oil impact, whilst it's going to have a near-term effect, the medium term is going to far outstrip it. In other words, what she's saying is that people are likely to start spending more aggressively, and that's going to feed into inflation in the medium term, which means that the Bank of England is going to need to have to act sooner rather than later. Okay. Don't forget, the purpose of a central bank is to ensure that they hiking rates before inflation gets to 2%, not when it gets to 2%. They need to be ahead of the curve, not behind the curve. Okay. So that's very briefly where we stand with the Bank of England currently. So what's the meeting format and structure? It's simple. 10:30, you get a nice bing, and out comes a statement on the wires. So you're going to have it on Reuters, you're going to have it on Bloomberg, and I'll show you an example of what it's going to look like in a minute. Okay. But the minute that comes out, all right, Mark Carney will then start his meeting with the Treasury Select Committee. And they're going to ask him all sorts of questions, and he's going to have to answer to their questions. Okay? At the same time, we're going to get a publication of the open letter. Okay, so because inflation is so low now, Mark Carney has to write a letter now. Every month that it remains below a certain point, he has to write a letter to George Osborne explaining why it is so low and how he intends to get it back above the threshold point. Okay. And in that, you'll see again, when I go a little bit later and I'll show you one of the outliers, in that letter there could be a huge trade opportunity. Okay. And in essence, what it's about is if Mark Carney comes out and says that if inflation falls beyond a certain point, we could start up QE again, all right, then that kind of a headline would be a very good trade opportunity because it's not what the market expects to see. Okay, let's move on. So very briefly, this is what your statement's going to look like. Okay, it's going to come out in that type of format. And I think the important thing is you're going to get all of this in one go. Okay, so if you're a short-term trader, you have to select one or two things that you're going to look at, one or two things that you think are the most market moving. Okay, so if you scroll down a little bit further, I've written there the key headlines to highlight. Okay, the key most important things you want to focus on straight away. Okay, obviously I'll highlight these for you guys on the Reuters for tomorrow, so you'll be able to see it straight away. But the key things is pretty much what is the Bank of England's medium-term inflation expectation. Okay, if that changes, you want to know about it. Remember, tomorrow's all about inflation. It's not about the near-term inflation. The Bank of England's told us the near-term inflation is likely to remain below zero and stay low for the next 6 months, so we know, or for the next 12 months, so we know that. Okay? But the medium-term inflation, i.e. 2017, is that still firmly anchored? Okay? Is that still at 2% like you expect it to be? If it's higher or lower, you're going to get some significant market moves. Okay? Then wage growth. Okay, again, the Bank of England's hammered on about wage growth for the last 12 months. Okay, this is probably the single most important data piece they're looking at. Okay, are employers getting paid more even though inflation keeps coming lower and lower and lower? Okay, if wage growth starts to turn lower, that's implying one of two things. Okay, that either there's a lot more slack in the economy, i.e. a lot more people coming back to get jobs. Okay. And it also implies that if wage growth goes lower, then inflation in the medium term might actually become de-anchored and go lower. Okay, so that's why we'll have a look at the wage growth and see if that trend is going to continue up, like the chart suggests, or are the Bank of England worried about it. And then obviously slack. Okay, the Bank of England continuously references that slack remains as they expected. So if they say that slack is being eaten up quicker or slower, that's going to be quite significant. Okay, so those are probably the three key headlines you want to look at on the Reuters at the 10:30 release. Right. Awesome. So the previous meeting. Very briefly, let's go over it so we can get an idea of where the Bank of England was back in November, 3 months ago, what their thoughts were back in November. Okay. So the Bank of England warned that inflation could fall below 1% in the next 6 months. It has fallen below 1% in the next 6 months. Okay. Year on year, we printed at 0.5%. Just 2-3 weeks back. Okay, so we're well below the 1% year on year. And again, they attribute that to lower food, energy and import prices and the slowdown in Europe and the rest of the world. Okay, so we know this. This is something the Bank of England told us 3 months ago. Governor Carney said he did not expect inflation to reach the targeted rate of 2% for 3 years. Okay guys, so the governor has told us inflation is not going back to 2% until 2017. He's told us that. Okay, so in order for the Bank of England to be more dovish on near-term inflation expectations, it's going to be very difficult because they've just told us already back in November, inflation is going to stay low, guys, until 2017. Okay, the market expectation of the first rate hike is October 2015. Okay, so that was back in November. Where are we now? Now the market's expectation is for Q2, Q3 of 2016. Okay, so that's likely to change. The bank also cut its prediction for UK economic growth. Okay, so they lowered the growth forecast. The bank said it expected average salaries to be growing by 2% at the end of 2015. In other words, they're saying wage growth by the end of this year should be printing 2%. Okay, so that was that continuous trend I've showed you. They become very hawkish on wage growth, the Bank of England. And then Carney said that it was likely he would soon have to write a letter to Chancellor Osborne. And surprise, surprise, he wrote his first letter after the January minutes. Okay, so all of this is what he said back in November. How much of this has changed? And that's what you have to ask yourself. Okay, how much has this changed since November till now, till tomorrow's meeting? Okay, let's go down a little bit. So, what has the inflation data since November meeting done? Okay, it's very important to understand what the data pieces have done because the central bank, the Bank of England members are sitting down, or they have sat down, and this is exactly what they're going to discuss. They're going to look at each one of these important data pieces and they're going to then release a statement based on that tomorrow. Okay, so we're going to briefly look at it. Oil, since the November meeting, has dropped from $76 to $50 as of today. Okay, that's a 34% decline, guys. So again, expect the Bank of England to be dovish on near-term inflation because they've said oil continues to lower our short-term inflation expectation. Okay. So again, it's not a surprise if suddenly they are very dovish on near-term inflation because it's already in the market. Everyone knows oil's dropped that significantly. Okay. Retail sales. We had a wonderful retail sales print just 2 weeks back. Okay. It came in at 0.4% when it was expected to be minus 0.6%. Okay. So again, they've been talking about the impact or the consumer impact of lower oil prices. Okay. Remember, if you have a drop in oil prices and it's cheap at the petrol pumps, it almost feels like you got free money in your pocket. Okay, so what do people do with free money? They go and spend it, and that's what the Bank of England's talking about. They're saying how initially, yes, oil's going to lower our inflation, but over the longer run, okay, consumers are going to spend this money, and that's going to make inflation start to rise quicker. Wage growth, okay, probably the single most important data piece the Bank of England is looking at the moment. The average earnings, right, was as expected, 1.7 versus 1.7. But remember, what's the current year-on-year inflation rate? It's currently 0.5. What's the current wage growth? 1.7. So in other words, people are earning more than the current inflation rate. That's positive, guys, because what that says is so long as that wage growth keeps growing and keeps trending higher, eventually the impact of higher wages will start to filter into the inflation data. Okay, don't forget, inflation data can be a lagging indicator, and there's a very good reason for that. As we add lower oil import or prices, so for instance, the year-on-year, as we add oil prices to the year-on-year import, eventually 12 months down the line, what's going to happen is that impact of oil is going to start to fall out of the calculation of the year-on-year inflation. And ultimately what's going to happen is you could have a month, for instance, where we have an outlier inflation number, where suddenly inflation goes from, say, 1.2% to 1.6% in 1 month. Okay, as the oil impact starts to drop out and the wage or the wage growth impact starts to filter in further. Okay, you all understand that? Then, of course, the UK headline data came out at 0.5 versus 0.7. So again, very, very low number, missed the expectation. But is it new news? No, it's not. Okay, we know, we can see that inflation is being impacted by oil. Okay, so we shouldn't be surprised to the downside, but we should be surprised to the upside. Okay, unemployment rate again continues to go lower month after month after month, and the GDP came in at a slight miss of 0.5 versus 0.6 expectation. Okay, but again, remember GDP is going to be very closely linked to this global slowdown. We just saw the US economy, their GDP also missed by a good 0.5%. Okay, so all global economies are kind of missing on their Q4 GDP forecasts. All right. let's have a look at the quick charts, just very briefly. Scroll up a little bit more. Okay, so as you can see, oil was trading somewhere around there. Okay, I'll just make it this. Okay, effectively, oil was trading somewhere up here, guys. Sorry, I can't fit the chart on the page. So that's where oil was at the previous meeting, somewhere around 77 bucks. Okay, and now oil's currently trading somewhere around that, 50 bucks. So as you can see, we've seen this very, very strong downtrend in the oil price. Okay, that's kind of what all the central banks are talking about now, is the impact of lower oil. Okay, next chart. Okay, this is the retail sales. As you can see, guys, this is the long-term retail sales. I know you guys can't see the data. Sorry, the light's a bit bright. Yeah, turn it off. Okay, so as you can see, if you scroll down a little bit first, I can see the dates. Okay, so from 2009, it's the crisis years, retail sales is just slowly trending higher and higher. So making these higher highs, higher lows. Yes, over the last couple of months, we've just come down a little bit. So over the last sort of course of a year, we stuck inside this sideways range. But again, that's because of the impact of wage growth. Remember, the consumer can't spend more if his wages are stagnant. Okay, we know public sector wages have been frozen since the crisis. People haven't earned much more over the last 6 years. Right? So what we would expect to see, whilst the long-term trend is firmly up, what we would expect to see at some point this year as wage growth starts to feed through is we want to see this little, if I make this a little bit tidier for you, we want to see that little double top taken out at some point. Okay, so we can see the trend continuing to the upside. Okay, next chart please. Okay, what have we got here? We've got the most important chart for the central bank at the moment. Okay, very briefly, you can see that over the last sort of couple of years, wage growth has kind of wanged around, remained relatively stagnant, okay, not really gone anywhere. But since that downprint we had back in September last year, we've had 6 months in a row of upward trending wage growth. Very, very positive for the Bank of England. Okay, what we'd like to see is get above 2%. Okay, but why would it be important for the 2%? Well, simple. The central bank wants to target 2% inflation. Okay, so if consumers are earning above mandated 2% inflation over the long run, eventually inflation is going to have to catch up, and the Bank of England can afford to then start looking at hiking interest rates. Okay, but so important, guys, so long as that trend remains up, okay, the Bank of England is going to look very positively on the outlook for inflation. Okay, if that turns down suddenly and we start to go back towards 1% and then 0%, we've got a little bit of a problem in terms of how we're going to go forward in the UK. Okay, next chart please. Right, yeah, we've got the CPI. You can scroll a little bit up for me. Okay, as you can see, I've just pointed out the 0% there. It's very likely we're going to get to 0%, and it's very possible that we actually print a negative year-on-year inflation print. Okay, so yes, it's going to scream, and the headlines in the newspapers are going to go, UK enters deflation. Okay, but at the end of the day, you've got to remember the impact. The reason we are getting that close to zero is because of the oil impact. So don't forget that. So long as wage growth keeps going up, that inflation will eventually turn. But yes, right now we are firmly in a downtrend, and that's why the market is so dovish on the outcome for a first interest rate hike in the UK. All right, next chart please. UK unemployment. Okay, wonderful chart. Need I say more? Just a straight line down. Okay, just bear in mind that when the UK talks about slack, they're talking about the likelihood of more people coming back into the workforce looking for jobs. Okay, so long as this unemployment keeps going down and wage growth keeps going up, okay, that slack is being eroded day by day by day. Okay, they will talk about slack tomorrow, so just keep your eye out for that. Okay, next chart. Okay, and the last chart is the UK GDP. As you can see, we've now had almost 2 years of positive GDP. So we are growing, guys. That's the important thing. The UK is growing positively. Right. If we weren't growing, if we were growing like the Eurozone is, which is near zero, and we had no inflation, then we have an issue of recession or of negative inflation. Okay, but right now we're still growing even though inflation is low. Okay, brilliant. Let's move on. Okay, so the next part is the market price in expectation. This is where we're going to determine how we can make money as traders. We've got a brief idea of what we know about the Bank of England, but now how are we going to make some money? Okay, so very quickly, the Bank of England is going to be more dovish than the November meeting. That's expected. We can see from the data, inflation in the near term is low. So they're going to be dovish now. That is priced into the market. Okay? And it could dip lower. So again, if Carney comes out and he says, you know what, inflation could become negative over the next couple of months, right? You've got to ask yourself, is that hawkish? Or sorry, is that dovish? Well, the simple answer is no, because we're expecting it to go to negative. He's told us for the next 12 months it's going to be negative. Okay? That's why it's priced. It's expected from the market. Right? We're expecting downward revisions to the GDP in the near term. Right? But possible upward revisions to the medium-term forecast. In other words, if the Bank of England thinks that this wage growth or this inflation is temporary and longer run, the oil is going to have a positive impact on the economy, then they may actually take their GDP forecast for 2016, 2017 and revise them upward. All right? Downward revisions to the 15 and 16 inflation, okay, near-term inflation being downgraded, but potential upside revision to the 17. Okay, that's very important, guys. Make sure, if you're going to watch any single thing, make sure you look at what they do to their 2017 forecast of inflation. If that gets revised above or below 2% in any significant way, you're going to get significant market moves. It's as simple as that. Okay? Because central banks are all about their medium-term forecast for inflation. So it's expected at 2%. If it comes out at 1.8%, you've got a trade on. That's a very dovish medium-term outlook, and you're going to get a response in particularly the gilt market. Right? But equally, if they revise it to say 2.1 or 2.2, with the market being so dovish on interest rates, and suddenly the central bank revising upward their medium-term forecast, okay, that could see the markets very aggressively bring forward the first potential rate hike, maybe to the beginning of 2016, late 2015. Okay, do you all understand that? Brilliant. Then inflation is likely to be negative in the months ahead. Okay, so we're expecting them to keep reiterating that low inflation in the near term. All right, first rate hike is for half 2 2016, so that's the market expectation. Okay, and then there's a positive outlook for wage growth. Okay, we've seen 6 consecutive months now of rises. So again, we're expected to see them reiterate that there's a positive outlook on wage growth. So if they said suddenly that there's a negative outlook, which is very unlikely, right, that's not expected. The market expecting a positive outlook. Right, unchanged on the level of slack in the economy. So how are they going to talk about slack? Okay, are they going to say it's being eroded a lot quicker than expected? If that's the case, okay, again, that could be perceived as really hawkish. But if they say there's possibly more slack than expected, okay, that could be perceived as relatively dovish. So at the moment, we're expecting unchanged on the level of slack. And then they're going to maintain the view that the oil impact should be looked through, as it will have a positive spin-off in the medium term. Okay, you all got that. That's what the market expects. That's what the price in the pound, the price in the gilt is reflecting to this point. Anything other than that expectation, you're going to get movements either way. Okay, so let's have a quick look now. And if you just have a look, that's briefly your table of expectations, complements of the banks. So they are looking currently for a 2% in 2017 in terms of inflation. And I'd say that's probably the most important. I mean, we know unemployment is trending down. We know near-term inflation is trending down. So, you know, and we know GDP in the near term is going to be low. We know these things. So the important one to look at is, what does the central bank tell us about medium-term inflation? Okay, so where are the outliers? And this is the fun stuff. Okay, what I've done is I've listed these for you. These are my outliers. Okay, but you guys can come up with your own outliers based on how you understand the Bank of England. Okay, so the first one, and I've listed them in order in terms of highest probability or most likely to occur to least likely. And the reason I do that is not just for you guys to see, you know, what could happen and what's very slim chance of happening, but also the more unlikely something is to occur, the more aggressive I want to be as a trader. Okay, the more size I want to get into the market. All right, so first one, I've said wage growth rising faster than expected. Okay, we've seen that chart now. It's near on 1.7. It's nearing that 2% targeted mandate by the Bank of England. So if they come out and they say that, you know, wage growth is actually picking up a lot quicker than what we thought, okay, that's going to impact the medium-term forecast for inflation. All right, and that's very, very hawkish. The Bank of England says that, you know, wage growth is going up very nicely and very quickly. All right, those expectations for a rate hike are going to be brought forward very aggressively. Okay, so that's my first outlier. My second outlier, there's more slack than previously forecast. Right? We've just seen now, currently in the US, we're seeing this case where unemployment's actually starting to tick up. The participation rate in the US is starting to come back to the fray. In other words, a lot more people are seeing jobs in the US and are actually coming back into the economy. Okay, if that's the case and wages stay low, then it means there's actually more slack than the Fed initially thought. We're not seeing that in the UK simply because wages are growing. So long as wages are growing, that slack is being eroded. Okay, then, so again, not very likely, but could happen. Would be perceived as very, very dovish if they came out and said that there's more slack. Then the third one, if they lower or raise their medium-term outlook for inflation. Okay, again, they very much expected to keep it at 2%, but if somehow they were to lower it to 1.8 or raise it to 2.2, I'd be very aggressive on both sides, hawkish or dovish. Okay. Then, if they came out, okay, Mark Carney did say in his Mansion House speech last year in July at 8 o'clock at night when none of us were here, he did come out and explicitly state the market is too dovish based on what the Bank of England is thinking. So he has openly said the market is wrong before. Okay, so again, whilst there's a small probability of it happening, right, it's not to say it can't happen. So if he was to come out and say the market's too dovish, right, that'll be very, very hawkish in terms of how the markets are going to move. And the last one, how is Mark Carney going to explain what he meant by his will, ability, and duty to return? In other words, what is he trying to tell us he's going to do if inflation cannot get back towards that 2%? Okay, so if he were to come out, and I've used the example as QE, if Carney came out and said that, you know, if inflation kept going lower and our medium-term inflation was lowered, we'd consider restarting QE. Okay, that would be the almighty dovish. And whilst there's maybe a 2% chance of that occurring, okay, it could happen. It is an outlier, but it could occur. Okay, so guys, as you can see there, those are pretty much my 5 scenarios in which I, as a trader, would trade the market. Okay, every one of those is going to give me a unique trade opportunity, right, in terms of entry, in terms of execution. Okay, so very briefly, let's just look at a little bit of structure. And I'm going to solely base this on the UK markets. And obviously you can trade other markets off the UK markets, but these are the markets that are going to be most impacted. And again, how I've listed these markets is I've listed them in terms of what's going to give me both upside and downside opportunity, i.e. hawkish and dovish opportunity. So the first market I got here is the UK 10-year gilt. The reason we look at the gilt is because it is inflation linked. Okay, so if you scroll down a little bit further for me, as you can see, this is a daily chart. We're in a firm downtrend. We have been since the beginning of 2014. All global bond markets are in this similar downtrend in terms of yield. Okay. What we have, however, seen over the last 7 sessions is we've seen a very strong rally in yield or sell-off in bond markets, particularly the UK and the US 10 years. All right. The UK gilts has gone from, what, 33s to almost 65. So a good, what's that, 32 basis points in 7 sessions. Okay, so there's been a very aggressive sell-side action in the gilts over the last couple of days, right? That's got very little to do with tomorrow's outcome. It's got more to do with the global backdrop, i.e. the US 10-year selling off. Okay. So what does that mean in terms of opportunity for me? Well, it means I know that the short-term trend is very firmly intact in the gilt market, i.e. there's a very strong bid in the gilts at the moment. So if, in terms of structure, I know this market's a little bit overdone in the near term. 33 basis points in 7 days is an overdone market. Okay, so from that scenario basis, from that structure basis, I'd be looking to trade this market from a dovish perspective. So if the Bank of England came out tomorrow and they said that their medium-term inflation forecast was 1.8%, I'd be looking to buy gilts aggressively at the market. Okay, because I know there's a very strong short position in the market, I should be able to get a pretty quick upside move. Right. It's not to say, however, that if they came out and raised it to 2.2%, that I wouldn't be looking to sell the gilts. Okay, remember, sorry, I'm talking in terms of yield and price here. So by selling the gilts, I'm looking to buy the yield. Okay. So it's not to say just because we've had this aggressive, you know, sell-off in price over the last 7 days that we can't go further. Of course we can. Okay, but I'd be more inclined to trade this market from a dovish perspective as opposed to a hawkish perspective. All right. Okay, let's move to the next chart. Sorry, let me just rub this out. There we go. Okay, so the next chart, is the short sterling. Okay, the reason I've referenced this and shown you this is, again, remember the short sters are not going to be affected by the inflation outlook, but they could be affected if a Marconi was to say, for instance, we could restart a QE, or if it was to say, for instance, that the market is too dovish, okay, or if, for instance, the market felt that the Bank of England was being overly hawkish. Okay, what they would do is they would effectively bring forward the first interest rate hike. Okay, so make sure whether you're trading the gilts, whether you're trading the pound, or whether you're trading any other market that's linked, make sure you have a short-term contract up, because they will respond most if they're bringing forward or pushing back any interest rate commentary. Okay, so very briefly you can see we've seen again, this is a weekly chart, a daily chart. You can see we've had a very aggressive reprice over the last couple of days. Okay, the short stirs are showing us that the interest rate expectation was very, very late in 2016, and over the last couple of sessions they've actually brought it forward slightly. Okay, and again, that's not got anything to do with the fundamentals of the UK, but rather it's got to do with the backdrop of bonds being a little bit overbought in the UK and the US. Okay, so again, make sure you have this chart up. If the short stirs start to sell off and get very aggressively, you know that Carney has said something particularly hawkish, something that's bringing forward the interest rate expectation. Also make sure you know what a move is. If the market moves 4 basis points, okay, in a DEX 2016 contract, that's not big. However, if you suddenly look at the chart and you see that the stirs are about 15 basis points lower, okay, that's a very aggressive move. That means Mark Carney has told us something particularly hawkish. Okay, and that rates are actually being priced for slightly earlier than previously. Okay, so use that more as a barometer for interest rate changes. And then the last chart, and probably my most favorite chart, okay, is the pound. This is the pound index. Works a little bit like the dollar index, not as closely followed, but effectively it just shows us how the pound has performed against all the other currencies or its major trading partners. And as you can see, for the last 4 weeks, we've had a stellar performance. Just last week, we were up 2.3% across the board. So the pound particularly at the moment is gaining against the euro and the yen for obvious reasons. The euro and the yen are both got contractionary monetary policy, whereas the Bank of England is looking to hike, being their next move, right? So the reason I look at this is because I know at the moment the pound is outperforming most of its currency peers. And as you can see, if you go a little bit lower, it's actually also outperforming the dollar. So this would be my recommendation for trade opportunity, simply because we've got both opportunity on the hawkish and the dovish spectrum. So what are you seeing here? You're seeing a daily chart. We've sold off since the beginning of the year, nice and aggressively. Over the last couple of weeks, we've formed a little bit of a basing pattern. The market's found some sort of a low, and we've seen a lot of two-way trade between buyers and sellers. We then formed what's traditionally known as a head and shoulders on the inverse. We broke above that last week, all right, and we've now kind of retested that lower bound. So looking at this market, it's not to say it can't go down or it can't go up. It can go either way. It's in a very finely balanced position where there's very easy opportunity for it to take out that high and continue aggressively to the outside. But equally, it could take out current prices and retest that neckline and maybe even take it and move to the downside. Okay. So whether Mark Carney came out hawkish or dovish, this market is going to offer you very good structure in terms of trades. Okay, and that's what you're looking for, guys. You're looking for the market that is going to be easiest for you to, either if you're bullish and you really want to get long, okay, maybe Mark Carney can give you that entry to get long. Equally, if you're looking for this head and shoulders to now continue its upside pattern, a hawkish move will give it that energy it needs to get the sellers to get out and bid the market back up higher. Okay, so that's what you're looking for in terms of structure, guys. You're looking for something that's going to give you easy opportunities to make quick money. Okay, you want to pop those lights on, please? So very briefly, let's just summarize. Okay, Monday, Tuesday, Wednesday, we've had very quiet trading sessions. The market is just waiting for some volatility. All right, that volatility could come in the form of Greece later on this afternoon, potentially. Okay, but more important, the QIR tomorrow is going to kick off the day. Remember, we've also got US retail sales tomorrow. So two very, very important data pieces from the UK and the US tomorrow. Okay. So use this QIR. Get a feeling how the QIR trades into certain levels. Okay. If you're trading the bond market and the gilts are selling off aggressively, but the bunds just can't go down with it, keep that information stored in your head. It's telling you somebody's still sitting in that market buying it. Okay, so the QR might not make you money, but it will give you a lot of clues in your individual markets. Equally, use the QR to get your fills at your key levels, whether it's the Eurostoxx, the DAX, the CAC, it doesn't matter. Okay, lean on the QR report tomorrow to get your entries where you need to. Okay. Any questions, very briefly? Does anyone want to ask anything about the Bank of England, about market structure, or about any trade opportunities for tomorrow? You all happy? Okay. Yes, Ben?
You know, you were saying about fading. Going back to your scenario,
yeah.
Out of those, which are the ones you'd be happy to fade and which ones wouldn't?
Market-wise?
Yeah.
The pound?
No, sorry.
Yeah.
You had 5 out.
Yeah. I wouldn't fade any one of those. They're all outliers. Okay, outliers you never fade.
No, sorry, not the outliers.
Yeah.
Can you scroll up? Sorry.
Yeah.
So I know what I'm talking about. You gave 5 outcomes with a reasonable degree of possibility.
Yes, the 5 outliers. They're all outliers. Okay, so outliers mean they're what the market doesn't expect to occur. Okay, so if they come out with any one of those outliers, I'm not looking to fade at any point. I'm looking to go with the flow because the market's not priced that way around. Right. Okay. Yes, of course, the statement could come out and have no single outlier. Then I'm going to have to rely on my technique and my price action skills to get involved. Okay. Cool. Awesome. Any other questions, guys? Brilliant. Have a good afternoon.
Cheers.
Thanks, John.